Not all investment income is treated equally. In fact, certain types of investment income, such as that offered on high-quality Canadian dividend-paying equities, can be more tax efficient and may offer growth potential over time. If you're solely relying on fixed income investments, such as guaranteed investment certificates or bonds, for your investment income, the issue is that these investments rely solely on interest rates. Interest rates will vary from year to year, which means your income stream will be unstable. If you purchase a 1-year guaranteed investment certificate, 1 year later you need to renew the investment. When you go to renew a fixed income investment, the interest rate available at that point in time will determine your rate of return going forward. The interest rate you receive when you first buy a fixed income investment and the interest rate when you renew that investment are almost always going to be different. In some cases, the interest rate will have declined meaningfully over the period, and so that the renewal rate is much lower than the rate you received before. This is known as reinvestment risk. The other challenge with fixed income is that interest income is fully taxable each year. There's no deferral or credits. When fixed income is held in a taxable account, the after-tax income is greatly reduced by tax. More on this in a bit. Interest income from guaranteed investment certificates or other forms of fixed income is not stable or tax efficient. The income stream on a well-designed portfolio of high-quality Canadian equities provides a more stable cash flow than guaranteed investment certificates, and it results in less tax being paid to Canada Revenue Agency. One of the items we like most about the dividend income is its stability. When you invest in a company that pays dividend income, the board of directors will declare the dividend quarterly as a stated dollar amount. This is not to be confused with the dividend yield, which is when you take the dividend dollar amount and divide it by the company's share price. The Greenard Group invests in high-quality dividend-paying companies that grow their dividends consistently over time. Another reason we like dividend income is tax efficiency. In fact, one of the most favorable types of investment income is Canadian dividend income. All publicly traded Canadian companies that pay a dividend will be eligible, and this means that the dividend is eligible for a larger gross-up and dividend tax credit. The higher gross-up and higher tax credit effectively results in lower tax rates than those payable on non-eligible dividends. Let's talk about how eligible dividends are taxed, as this is more relevant in this scenario. The reason for the dividend tax credit is because companies pay dividends out of their after-tax profits. Since there's already been a taxation at the corporate level, individuals receive a reduced level of taxation in their hands. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thank you for listening.